Cool, guys. I think most people are on. So I think let's kick off. I know quite a number of the Hereford guys are at the Night Conference in Joburg, and another big chunk of the Hereford guys are on an incentive trip in Turkey. But welcome to all the rest of you who did join us this morning. It's great to see all of you again. We are running a bit of a special session this morning. We're not going to do our normal market view and general shortlist insights. We've got Matthew de Wet joining us from Abax Investments. Matthew is one of the senior portfolio managers there, man with many, many years experience, but Mike will give you a bit more background on that. So Matthew, thank you for joining us and welcome. It's great to have you on board. We look forward to the insights you're going to share with us. Guys, as always, you're welcome to ask questions at any time. Just put your hands up or put your mic on. If you're not asking a question, please do keep your mics on mute. You can also type the question in the comment section, and then we'll get to it as soon as we can. So on that note, I'm going to hand over to Mike to take it from here. Thank you,
Awesome.
Mike.
Thanks, Adriaan. Yeah, as you said, thanks very much to Matthew for joining us from Abax. I know obviously Abax is probably a name that a lot of you guys won't be that familiar with, but as Tawanda was mentioning earlier, they've got they have their 20th year anniversary this year. They've been around for a long time, and we'll let Matthew introduce that in a couple of minutes. As Adriaan said, I mean, this is largely going to be a bit of a Q&A session between myself and Matthew. I've got the easy part. Matthew's got a few slides to help chat through some of the questions I'm going to be asking. But the idea is we've made sure that we're going to finish in time, that there's questions that you guys can ask. I know obviously you get to ask us questions on a monthly basis, but having one of the underlying portfolio managers from our solutions in the meeting is I guess something that we can offer you guys, that you can, if you have specific questions on the funds that they manage or on their views, it's great to get it from the horse's mouth rather than I guess speaking to us and us kind of getting the answer from the manager and then relaying it back to you. So please, get those questions queued up, pop them through, and we'll definitely have time at the end of the session. So just to give a bit of an intro into Abax and how they fit in the seed offering. Let's see if we can go across. So the relevant funds that we're going to be sort of referring to today is the Ned Group Opportunity Fund. So I mean, that is a fund launched by Ned Group. Abax, correct me if I'm wrong, Matthew, but Abax has been managing that since inception.
Correct.
In fact, Matthew was at Ned Group. So he would have been a part of the team that appointed Abax to manage that when that was launched in 2011. But as you can see, the Ned Group Opportunity Fund sitting in the medium equity category, the Abax Balance Fund in the high equity category. Both funds are managed by Omri Thomas and Matthew, with Matthew taking more of a lead on the Balance Fund and Omri on an Opportunity Fund. And these are well-established funds in terms of size, and both have a 10+ year track record. So as mentioned, these guys aren't a small house, even though they are sort of quite a tight boutique, if I can put it that way. And just the exposure, so where you guys will see Abax, if you are using the seed solution, if I can put it that way. The first part is in the stable fund. We've had Ned Group Opportunity in the fund since March 2016, so we're going on 7.5 years invested there. Currently around 12.5% allocation to the Ned Group Opportunity Fund. The Balance Fund, more recently invested into Abax Balance. So for a much longer period, the seed Balance Fund was investing more into building blocks. But I guess you saw partly the success of the Ned Group Opportunity Fund within stable, and that was partly drove our thinking around looking to maybe include some more multi-asset strategies in the Balance Fund. And in October last year, so coming on to 1 year, we put the Abax Balance Fund in, currently around 10% of the portfolio. For the Hereford guys that use the DFM solutions on Stanlib, the seed moderate solution has a 30% allocation to the Ned Group Opportunity Fund. And then on the shortlist, again, I guess the same two funds. Ned Group Opportunity was added in April 2013, so been there for over 10 years, and I guess fairly soon after seed and Hereford started their journey together. And then again, as we've kind of expanded the shortlist towards the end of last year, Abax Balance got added onto the list. Then just briefly looking at the performance. So first year, the Neg Group Opportunity Fund. It's been a slightly tough 1 year period, 1.5% behind the peers, but in it's sort of still a decent nominal return. But I guess like we try and tell you guys, we long-term investors, Abax are long-term investors. So for us, the long-term numbers are the more important ones, and you can see top quartile over 3, 5, 7, 10 years, and in fact, the top performing fund in the category over 3, 5, and 10 years. So from a performance side, they've done exceptionally well. If we go on to the next slide, we can see the risk and return versus their peers since inception. And the one thing that maybe doesn't show in this chart is that it is a sort of has a high volatility, but when you drill down into the stats, most of that volatility is upside volatility. So it's a good volatility. When you look at drawdown analysis, they're pretty much close to their peers. So essentially, you get paid to take on that volatility in this fund. As you can see, the top performer since inception. And then on the Abax Balanced, so it's on top of the longer term numbers. It's also had a good 12 months, or a very good 12 months, if I can put it that way, generating nearly 22% over the past 12 months. And as you can see in the top 2 or 3, or top 1, 2 or 3 funds over 1, 3, 5, 7, and 10 years. So I guess this is performance, and I sort of in preparation with this, I was chatting to Matthew, and he said, please don't crow about this. When you allocate to managers, as much as we'd love to see these kind of sort of consistency of return at like right at the top end of the peers, it's not something that we expect. We do expect, I guess, the sort of longer term top quartile returns. But when you can get returns like this, it is just the cherry on the top, and makes our lives as multi-managers a lot easier. And then just on the risk return scatter. So again, you can see since inception, excellent performance versus the peers. Again, a lot of that extra volatility versus the peers would be on the upside, and essentially they're you're getting paid to take on that sort of upside, or take on that risk. And again, when you look at sort of drawdown and downside risk stats, they are more in line with the peers. So you get that asymmetric upside downside payoff, and I think Matthew will touch on that a bit. And I think that's Lisa. I think that's us from our side, kind of just introing them, and rather than me kind of giving the whole Abax story, I thought we'd start with Matthew to, if you can just give us a bit of an intro, a brief overview on Abax.
Sure. Thanks, Mike. Thanks, everyone, for coming to listen, and we appreciate the support. So Abax, as we were chatting earlier, is a business that started 20 years ago. And when we started, we really had one objective in mind, which was to deliver good performance for clients. That's why we're in business, and that's what we spend all our time trying to achieve. You know, we're independent, we only do investments, and I think we're one of the few wholesale-only managers in SA. So none of the Abax products are actually ready available to the retail market. We have a small number of large clients that we focus on, and those large clients in turn often have a number of their own clients. Everyone in the team owns shares in the business, and 75% of our business is owned by people in the team and 3 charitable trusts that we've set up. And then a small minority is owned by a listed business in the US called AMG, which owns stakes in about 40 different boutiques around the world. And we're level 2 contributor. We think that our investment team is one of our key differentiators. There's a team of 16 investment professionals here with an average of over 20 years experience. Key to that is that the core of the team has worked together for a very long time. There have been very few people leave the business over the years. In fact, really the only senior person to leave retired, and we've had one senior person departing over the 20 years to join a competitor. All of us are invested in the funds. In fact, everyone's pension fund here at Abax is invested in the Abax Balance Fund. And we've tried to keep things as simple as possible. So we don't have any salespeople, we don't have any marketing people, we don't advertise. We run few mandates for few clients, and that allows us to spend most of our time on what's important, which is trying to find investment ideas. If you move to the next slide, Lisa.
Yeah, thanks.
Yeah,
Thanks, Matthew.
Sorry, the only other point I'd make is we have about 100 billion AUM, and that means that we're large enough, to have a full-scale investment team across the various asset classes and geographies, but still small enough to take advantage of opportunities in the small and mid-cap space. And that's actually an area where we've always dedicated a portion of our research and where we have managed to find some value-adding opportunities.
Great, thanks, Matthew. And I think from our side, I mean, that's always something that's important from us as when we do our manager due diligence is ensuring that the managers focus on managing assets, and it's not a distribution business masking itself as an investment manager. So we appreciate the likes of Matthew and his team spending 90% plus of their time focusing on investments. I suppose they're fairly unique, as you mentioned, in terms of how they structure themselves to avoid having to spend lots of time speaking to clients. And when I jumped on the line with Matthew at first thing, I was asking him, is this something that he does often? And he says, no, it's not really that they do this kind of thing often. So again, you guys are lucky, and we're privileged to have him coming to speak to us. So obviously you say you've got 100 billion asset management. It gives you the reach across the different asset classes. Can you just give us a brief summary of your philosophy and your process, and Herman, on like what differentiates you guys from your peers?
Sure. So we're talking here mainly about our multi-asset approach, which would obviously encompass the opportunity and the balanced funds. I'd say key to the approach is obviously an understanding of the opportunities available across the different asset classes at a point in time. So our approach to that is a top-down and a bottom-up approach. We have fair value models for all of the asset classes. What we're really trying to understand when we look at the asset classes is, at a particular point in time, what risk premium is baked into that asset class versus what risk premium we want to earn from that asset class, given how we see the current outlook. So just to make that more alive, at the moment, we would look at the SA bond market, for example, and we would look at what risk premium is available to us. You can kind of back that out by, looking where risk-free rates are globally, looking at our inflation differential to global markets, and then working out what country risk premium you're earning for investing in South Africa. And we would then try and establish whether that's fair or not, given everything we know that's happening in South Africa at the moment, given what's happening to our debt metrics, given the low growth environment, given the lower commodity prices. So we really try and understand what's on offer, and is that enough given the risks that are around. Then, of course, we've got to integrate that with our bottom-up views. In some asset classes, that's more important. Something like South African property is a good example where, there are only a few listed South African property companies, each with their own idiosyncratic risks. It's much more important to understand each of them individually than it is to try and form a view of the overall asset class, which is quite hard to do. So there's this balance depending on the asset class between top-down and bottom-up. We also like to analyze securities across the capital structure. So we would look at the top, we would look at the equity, we would look at the preference shares, we would look at convertible bonds if they have, we would look at normal credit bonds if they have, and we would look at just, across the capital structure, and try identify that part of the capital structure that can give us the best risk-adjusted returns. And what we really like to look for is investing in parts of the capital structure that can give us an equity-like return, but with risk lower risk than taking on full equity risk. So if we can find a convertible bond, for example, and I'll talk about this a bit in more detail a bit later, where we can get some of the equity upside but have bond-like risk, that's the perfect kind of asset class for these mandates. We spend a lot of time on portfolio construction. We think this is a really important part of the investment process. We try and understand the drivers of risk and return in each individual position and in groupings of positions. And in order to, control against what we don't know and what we can't forecast, we'll make sure that we're always diversified across geography, asset class, industry, style, and at an individual security level. And then where we're still uncomfortable around some of the downside risk, we will overlay hedges to take some of that downside risk out. And again, I'll touch on this in a bit more detail later. I think this is quite an important slide to understand what we do. We really try and add value to the portfolios by utilizing the widest possible toolkit. So two of the tools that we use and that you would be quite familiar with, I'm not going to spend too much time on them today, would be asset allocation. So we vary our allocations to the various asset classes as opportunities present themselves. We obviously analyze the individual securities and try pick the most attractive stocks on a risk-adjusted basis. I think these two things are probably quite well understood by you. So given the interests of time, I'm not going to focus on them too much today. But I think some of the remaining tools may be differentiators for us. The first would be hedging strategies, where we try and explicitly remove some of the downside from the riskier asset classes, and I'll give you an example of that later. We have managed to add value by investing in hybrids or in different parts of the capital structure. I'm going to give you an example of some of the convertible bonds that we've invested in over time, and some of the AT1 bonds, which is alternative tier 1 bonds. It's all a bit of a mouthful, but I'll just show you some examples of that. On the fixed income side, I think we have a very deep capability here. We've got a number of members on our fixed income team, and it is an area that we focus a lot on. And we're quite active in that part as well, and that is an important building block in the overall mix. And then I touched briefly already on portfolio construction and diversification. It is an integral part of the process and is something that takes up a lot of our mindset to make sure that we try and build portfolios that we think will be okay in most situations. So what we don't want to do is build what we call a 0-1 portfolio, where if our view of the world transpires, we will hit a home run. But if that doesn't happen, we'll have a really poor outcome. We'll rather try and construct something that will be okay in most outcomes and will do pretty well if our view of the world does transpire. So let me talk now in a little bit more detail about one or two of these. The first would be hedging strategies. If you move on to the next slide, you can see there that we make active use of hedges in the funds, and generally we do that to try and protect some of the fund against falling asset prices, and to try and really manufacture what we would call an asymmetric payoff profile, a profile where we can participate in some of the upside but remove some of the downside from risky asset classes, normally equity. So how we would typically do this is we would implement what we call a short fence. It's a bit of a mouthful, but all that really means is we would remove the first bit of the downside from our equity holding, or a portion of our equity holding. So normally we would protect for, call it an 8 to 10% fall. So, if your equity is at 100, you would be protected from 98 to 90, and if the market continued to fall below 90, you would then start participating in that downside. So you're just removing the first bit of the downside. Why we typically don't protect the whole thing is because it can be expensive to buy that protection. It's like an insurance policy. You've got to pay for it. There's a premium you need to pay. And we want to make sure that we're getting good value for our premium. The way that you can do that is you can also potentially fund it through selling away some of the upside. Typically in the South African market, that would mean that you could still earn an annualized return of 15 to 20% from your equity holding, but if markets move up more than that over the year, you would potentially be capped out. So by selling away that upside, you can effectively fund your protection on the downside. We do also overlay hedges occasionally on single stock positions, but more typically on the overall equity allocation. The one thing that's changed more recently is, as you know, Reg 28 has expanded to now allow up to 40% of your assets offshore. Previously, that was just 30%. So what's going to become more important is how you manage your currency exposure. It's quite clear to us that there are a lot of exciting opportunities available overseas relative to what's available in South Africa, but it can be quite risky taking your full 45% offshore because you take on all of this currency exposure, and that amount of currency exposure can influence your returns in the short term and create quite a lot of volatility in your fund. So we like to look at our offshore exposure and our currency exposure separately. We will often hedge back some of our currency exposure into rands to remove that portion of the volatility. And this is just an interesting optimization that we wanted to show you, which kind of looks at different CPI plus targets and what the optimal asset allocation is to give you the highest chance of meeting that target over a 5-year period. So, you know, the opportunity in the balanced funds, they have inflation targets of kind of in that 5 to 6 to 7 range. You can see there that the offshore allocation is above 40%, closer to 45, 50% in all of those examples. But what's interesting, if you look at the fine print here, actually the global equity allocation is pretty equally split between global equity and currency hedged global equity, where you effectively take your money offshore, buy the equity and hedge the currency back. So if you look at the balanced fund as we stand today, we have our full 45% offshore. We actually acted quite quickly when Reg 28 changed last year, but we don't have the full 45% currency exposure. About 12% of that 45 is hedged back into rand. And what that does is it takes that currency volatility out of that component and effectively adds the interest rate differential to your return. So if you, like we do, we've got a basket of different credit bonds and fixed income instruments offshore. This makes up about 10% of the fund. That basket is yielding around 8% in dollars. We hedge that back into rand. We can get about 12% in rands, but we remove the currency volatility as well. So it becomes a very low volatility asset class. It's effectively a new asset class that you've introduced into the mix, which obviously has broader portfolio diversification benefits. I think we can move on. Another example I wanted to share with you would be around some of the hybrids. So if you go to the next slide, I think there's a chart of the payoff profile of a convertible bond. This is a really nice asymmetric payoff profile. A convertible bond is simply a credit bond with a built-in call option. So kind of what happens is typically a convertible bond would be 5 years. The company would issue that convertible bond. They would pay you a coupon for those 5 years. It would typically be a bit lower than what would be available if it didn't have the convertible option embedded in it. But you can still earn a decent return over those 5 years. But if the share price goes up, you participate in that upside. And if the share price goes down, you just get your coupon and you get your money back over 5 years. So we did quite well out of some of the platinum convertible bonds, where we were earning a coupon of around 7% in rands for 5 years, and we managed to participate in some of the upside, but we were protected from some of the downside, or from all of the downside, in fact. So that gives you a very nice asymmetry, and for a fund that's trying to beat inflation or not to lose money over a particular period, that's a very nice kind of asset class. As I said earlier, we do look across the capital structure. This is just an example of the things that pop up from time to time. If you are able to invest globally and you are nimble, you guys will recall what happened to Credit Suisse earlier in the year, in March of this year. What then happened is some of their bonds, effectively the bonds that are least senior in the stack, kind of fell out of bed, not just their bonds, but all bank bonds across Europe, as there was a little bit of a short-lived panic. You can see this is just an example of the price of one of those bonds. It was kind of pricing at around 85, quickly fell to 75, and you had a chance to buy those bonds, which then subsequently recovered back up to 85. So that was a bit of a panic sell-off. These types of bonds are not suitable to income funds because they are just senior to equity, but they are lower risk than the equity and they pay you a very juicy coupon. So for a multi-asset fund, as an alternative to buying the equity, the risk-adjusted return is far superior. So we would, for example, rather own these than owning the equity of the underlying banks. So what we did in short course is we bought a basket of some of these bonds. We tried to find the bonds, the banks, the issuers with the best kind of capitalization ratios, and we bought a basket of these bonds, about 2.5% of the fund. They had about 2.5 years to go when we bought them, and at the time that we purchased them, they had a yield in hard currency of 11.9%. We hedged that back into rand, which gave us a rand yield of about 15 or 16% for taking on 2-year duration. Now, the one thing that can happen with these bonds is that they don't get called by the banks. It is up to the banks to decide that they want to call them. If they don't get called, so in other words, you don't get your money back after the 2 years, what happens is they convert from fixed rate bonds into floating rate bonds. But they do that at a predetermined spread. So at the time we purchased them, we knew that if they didn't call those bonds, these would convert into floating rate bonds at 7.5% above whatever the 5-year bond yield was at that time. And it would float with that 5-year bond yield. So you don't have duration risk anymore, you just have the credit risk of the bank. Now, 7.5% above the 5-year bond is a higher return than you would demand for investing in the equity of those bonds. But you are senior in the capital structure. So from both a return and a risk perspective, you have a better outcome. That's the kind of thing we like to look for.
Awesome. Thanks, Matthew. I think from our side, when we speak to Abax, the one word that's kind of comes up all the time is asymmetry. And I think that's a key component of their process, and maybe something that Matthew hasn't touched on is they also quite often make use of kind of structured notes where, again, they manufacture an asymmetric payoff. I guess to a certain extent, we've taken that idea, having gone through the due diligences with them and seen how well it works in their portfolios, and something that we implement in our portfolios, aside from the Abax exposure. But again, it's asymmetry. It's like, how can we make sure that upside optionality is much greater than any downside risk we're taking? And as I mentioned at the beginning of the presentation, the returns bear it out. I mean, we've had the Opportunity Fund on our shortlist for 10 years, so we've been following them closely since even before then, and we've seen any of these Nene Gate sell-offs, COVID sell-offs, any periods of down markets, while they have typically performed, they've gone down almost in line with their peers. The upside out of that has always been at a much higher rate, and I guess out of COVID, especially in the last 12 months, we've seen that in the balance fund. But yeah, just chatting on the two products there, Matthew. Can you just briefly, just 1 or 2 minutes, just give us a sort of the differences and similarities between the Opportunity Fund and the balance fund, and I guess then that will almost speak into why we've got one in our stable fund and one in the balance fund. I think you're on mute there, Matthew.
Oh, sorry, I didn't know how that happened. Yeah, so we're talking today about the Opportunity and the Balance Fund. I've just got the Absolute Fund there, so you can see how they kind of all fit into the range. And it would be your typical sort of range from your low equity, medium equity, high equity strategy. But I think over and above that, there are a few key differences between the Opportunity and the Balance Fund. The first is the Opportunity Fund has a dual objective, so that asymmetry that Mike was alluding to earlier is an even more important consideration than it is for the Balanced Fund. So for the Opportunity Fund, we're targeting returns of inflation +5 over rolling 3 to 5 year periods, but we're also trying to not have any negative 24-month rolling periods. So both of those objectives are as important as each other, which means you will typically find more hedging in the Opportunity Fund. You will typically find a greater allocation to some of the asymmetric kind of opportunities. You would typically find a greater allocation to high-yielding fixed income instruments that can give us a higher probability of meeting that CPI +5 over that rolling horizon. In that fund as well, we actually limited to 60% in equity, where in contrast, on the balance side, we have a single objective, which is to outperform the peer group. And there we can have up to 75% in equity. So you're likely to find a bit more, for lack of a better word, beta in the fund than you will find in the Opportunity Fund, because this fund is really used by people who are still saving up for their retirement, and they've got a longer term horizon and they want to maximize that lump sum on retirement. The Opportunity Fund would be more suited for people who are near a retirement or in retirement and potentially are drawing about to or are drawing down from that investment. And as you guys know, when you have a lot of volatility and downside and you're withdrawing from your investment, that can create very negative consequences. So the two portfolios are really are designed with two different needs in mind, and how we build them is very much with those needs in mind.
Perfect. Thanks, Matthew. And as I said, so the Ned Group Opportunity falls into the seed stable fund, also having a sort of objective of trying to protect capital. The stable fund slightly shorter period, but we know that this Opportunity Fund is kind of a more sort of higher risk component of the stable fund, and we balance it appropriately. And then the Abax Balance Fund, as I guess with the name, it does fall into the seed balance fund. Matthew, just how do you guys see the world at the moment, and where are you finding opportunities? If you can kind of highlight some of the key areas that you guys are looking at the moment.
Sure, I got a few charts which I was hoping to share with you guys. The first one, to me, this is the key chart if you just had one chart to talk about, this would be it. This is the real yield on the US 10-year inflation-linked bond. This is the global risk-free rate. This is the rate against which all other asset classes need to be measured. And what's happened is that has moved in a very short space of time from a negative 1% to a positive 2%, and is now back to where it was kind of pre-global credit crisis. So it's the highest that it's been, in about 15 years, and kind of in line with the average of what it was prior to 15 years ago. So what this means is you can invest in the 10-year US inflation-linked bond, and you are guaranteed a return of 1.9% above whatever inflation ends up being over that period. Now, that's a pretty decent return for taking on US credit risk, and is certainly higher than what you've been able to achieve in most of our recent memory. Now, that when people value asset classes, it's obviously a relative decision. Am I going to invest in bonds? Am I going to invest in equity? Am I just going to keep it in cash? And the point is, when you are valuing the other asset classes, you need to evaluate them relative to this, which is the risk-free rate. And interestingly, that hasn't really happened yet. So if you move on to the next slide, you can see, maybe just move one forward quickly, and I'll come back to this one. Yeah, if you move on to this one, this is showing you the earnings yield from the S&P 500. It's kind of the inverse of the PE ratio. It's your earnings divided by your price. So you can kind of compare that to a bond yield. You can see if you take that earnings yield and you subtract the yield of the 10-year inflation-linked bond, the risk-free rate, for the last 15 years, that number's kind of moved between 4 and 6 or 7%, which means that the yield available from equities has been 4 to 6% above what's been available from the risk-free asset. That has fallen off a cliff. That is now below 3%, and certainly the lowest that it's been in many, many years. And on the right-hand side, there's a little histogram there that looks quite fancy. It's just showing you that over that period, it's kind of off the charts in terms of standard deviations. So real yields have shot up, but equity valuations haven't yet adjusted for that. And if you now go back to the previous slide, when we look at equity valuations, we try and adjust for the cost of capital, because businesses have a cost of capital, they have a cost of equity, they have a cost of debt, and the multiple or the fair rating for those businesses must change with the changes in that cost of capital. So when we look at what the fair value PE of the US market is, our fair value actually changes through time as that cost of capital changes. That's why we don't just have a single kind of long run average PE to be the fair value. The point I want to make at the moment is that if you look on the right hand side of this chart and you look at the little dotted blue line, that's our fair value forward PE to earn the traditional equity risk premium of 5%. That's typically what you want to earn from equities over and above the risk-free rate for taking equity risk. You can see that fair value has come down over the last year or two as those real rates have shot up. So, a year or two ago, you could argue where rates were, the fair value for the S&P 500 was a PE of 20. Now we're suggesting that it's closer to 15. But despite that, the PE has been going up. That's the red line. So now the gap between the fair value multiple and where the multiple actually is has opened up quite substantially, which in our mind is quite a risky setup. So we think, there is potential downside in this market. Okay, let's move 2 slides ahead now, please, Lisa. Fortunately, there is one really cheap asset class at the moment, which is protection. The cost to hedge against downside in the US market is pretty much as low as it's been, despite the market being potentially expensive and at potentially high levels. So we measure that by looking at what we call the VIX index, or the volatility index, and the lower the VIX or volatility is, the cheaper it is to protect some of your portfolio against potential downside. So you can see at the moment, volatility levels are pretty low. So what that means is you can still have some equity exposure, but you can overlay a little bit of protection, take out a little bit of insurance on that exposure, because the cost of taking out that insurance isn't that high at the moment. And I think we're all aware of how rates have moved up, how inflation is seeming to be a bit sticky, how there's lots of geopolitical issues. So it does feel like there's a lot of risk out there, but fortunately, you can protect yourself from some of that risk, and you're not having to pay too much in insurance. So at the moment on our offshore exposure, we do have some of it protected with some of these derivatives. Turning to South Africa now, this is our 10-year bond yield. Interestingly, that has moved up over the last year or two, but if you look at over the last year and a bit, it's kind of been moving sideways at the same time that global yields have moved materially higher. So relative to global yields, our bonds have actually been pretty reasonable. And I think that's because the starting point was pretty low. So if you look at the next chart, I think this is a key chart for us. Again, this is the US 10-year bond yield less the South African 10-year bond yield. The higher that chart is, basically the cheaper offshore bonds have become relative to local bonds. So what's happened over the course of the last year and a half is that South African bonds have become more expensive relative to global bonds, or you could say it's in the converse, that global bonds have become cheaper relative to South African bonds. And I'm not sure if that feels completely right, given what we know is happening to our fiscal situation, given load shedding, given our low growth economy, given low commodity prices at the moment. So either our bonds were very cheap to start with, or they've become a bit expensive relative to global bonds. We think it's a bit of both. We think our bonds were very cheap to start with and are actually still decent value. But what's changed for us is that global bonds have actually become an attractive and investable asset class for the first time, kind of in 15, 20 years. So global rates are now on the table as an investment option, where for most of our recent investment lifetimes, that hasn't been the case. What has happened, though, in the South African bond market is people have penalized the long end of the bond curve. So everyone is more worried about our ability to repay our bonds far in the future than they are closer in the future. So you can see this is the spread between the 2037 bond. I'm sorry, I think it's the 30 bond, yeah. So the bonds maturing in 2030 versus the bonds maturing in 2037. You can earn an extra 1.8% a year for owning those 37 bonds versus owning the 30 bonds. And that has increased from less than 100 or less than 1% just over a year ago. So basically what's happened is our bonds have re-rated relative to global bonds, except at the longer end where we've actually de-rated. So you might be being rewarded to take your duration in the longer end of the bond curve as opposed to the shorter end. Let's move on. What's also happened actually is our inflation-linked bonds have cheapened very nicely. And for the first time in years, we've been adding inflation-linked bonds to the portfolio. So you can now buy South African inflation-linked bonds, maturing in 2028, 2029, so 4, 5, 6 years to go, at a real yield, a yield above inflation of, 4.3, 4.4%, which is a very healthy kind of return, especially if you're targeting, returns of inflation plus 5%. You can get quite close to that without taking on any inflation risk and being quite short on the maturity spectrum. So we think actually inflation-linked bonds are also looking pretty good at the moment, and we've started adding to those. A year or two ago, you'd only get 2.5% above inflation. You're now getting closer to 4.5%. It's a big difference. In terms of the South African equity market, again, this is a similar chart to the one I showed you on the S&P 500. What we do here, though, is we like to look at the cost of capital for South African businesses and adjust for that. So we will take the global businesses that are listed in South Africa, the Richemonts and the British American Tobaccos would be examples. We would apply a global cost of capital to those businesses. And for the SA domestic businesses, we would apply a South African cost of capital to those businesses to try and work out what the fair rating for the market is. You can see again, and I think this is quite an interesting point, is that our fair value, which is the thick blue line in the middle for the South African market, has been coming down as the cost of capital has been going up. So even though the red line, which is the current PE of the market, looks low relative to its history, it doesn't actually look that low relative to the fair value because the cost of capital has gone up. So if you were just to say our market looks cheap because the PE ratio looks low relative to the average PE ratio of the last 10 or 15 years, we think you might be missing the point that the cost of capital has moved up and it's made generating profits harder for those businesses because they have to pay more for that capital. So we think the South African equity market is probably closer to fair value than it is screamingly cheap. And that might be a bit different to some of the commentary we see out there. That said, there are obviously interesting opportunities. There are always interesting opportunities within markets, but at an overall asset class level, we don't think the South African market is yet in bargain basement territory. And of course, we know there's very little growth in the economy, and it's costing businesses a lot just to stand still. So there are potentially more exciting opportunities elsewhere. So to summarize our views, we believe we haven't yet felt the full impact of higher interest rates and quantitative tightening. To us, it seems like there's quite a lot of risk out there, despite markets still being quite elevated, particularly overseas. We think it's going to be difficult for companies to keep growing profits because their margins are already high. We think and hope that there will be continued volatility because that creates opportunity, and if you are nimble, you can take advantage of those opportunities. Our South African equity view is, although our market isn't expensive, it is neither particularly exciting. Amongst the global equity markets, there are some very interesting opportunities outside of the large cap index stocks. So despite the S&P 500, for example, looking pretty elevated, a lot of that is driven by a small handful of stocks which have done particularly well. If you dig beneath that, you can find some really good businesses trading at multiples not too different from what's available in South Africa. But these are businesses that still have runway for growth, whereas in SA, to grow, you kind of have to take market share from your peers. Fixed income is pretty attractive at the moment, and should play a role in your portfolios. What's changed in the shorter term is that offshore fixed income has also become attractive. And the change to Reg 28 we've been very excited about. We just think it gives South African investors much better opportunity sets, and we don't agree with a lot of the commentary that we've seen that it introduces too much currency volatility, because you can manage that currency separately and you can always hedge it back to Rand and remove some of that risk. So to summarize, I've just put the various asset classes in cheap, fair and expensive. We think South African inflation-linked bonds, emerging market equity. I've kept SA equity in the cheap basket because it is slightly cheap relative to fair value, and protecting or derivative protection. Those are all cheap asset classes. In the fair value bucket, I've got South African property, developed market equity outside of the US, US bonds, South African bonds, and on the expensive side, we've got developed market bonds outside of the US and US equity.
Awesome. Thanks very much, Matthew. That's a very comprehensive run through of what you see the world like. I guess in the interest of time there, can you just briefly kind of go through how this translates into fund positioning, and then also how the funds have changed over the past 12 months? I think you have been muted again because you were echoing for some reason while I spoke.
Sure. Okay, if we just look at fund positioning, I would say to summarize our positioning on both of the portfolios, we are the most diversified from an asset class perspective as we've ever been. There's a reasonable amount of bond exposure in the portfolios. We are also the most diversified geographically than we've ever been. And I would say that if you looked at the quality of the underlying equity securities, we probably have the highest quality bias that we've ever had. So we've really tried to focus on businesses with strong balance sheets. We think, in a world where interest rates have just kicked up by more and faster than anyone has ever experienced, we think companies with cash on hand will benefit in two ways. Firstly, they will earn a higher rate on that cash, which will be a small tailwind to their earnings. But secondly, if there is a risk-off event and share prices fall, they will have the cash to firstly either buy back shares at discounted prices or take advantage of weakness in some of their competitors' share prices and potentially buy businesses or invest. Whereas if you have a lot of debt on your balance sheet, firstly, the higher cost of debt is going to be a headwind to your earnings, but also you just don't have any flexibility. You need to focus on refinancing that debt. You need to focus on paying it back. And if we have some kind of risk-off environment, you're going to be in trouble. So we just think, and we think there's an inefficiency there actually in the market at the moment, because everyone's got used to low interest rates, and everyone values companies on PEs at the moment. I don't know, you guys, you read the newspaper, whatever, everyone just talks about cheapness being in the form of PE. But we're trying to value companies higher up the income statement, more like an enterprise value to EBITDA kind of thing, where it takes into account the capital structure. So you're normalizing the capital structure. Companies with cash get the benefit. And then some of these companies with high debt on those metrics aren't nearly as cheap as they appear to be on a PE basis. Their PEs have been flattered by low interest rates. And now that interest rates are normalizing, it's going to go the other way. So I think you need to be very wary of that. So this is the opportunity fund. Quite difficult to read this chart, sorry, but we've got 22.5% in domestic equities and 16.5% in international equities. So a total of, let's just call it 40% in our net equity. That's net equity. The gross would be a bit higher. We've got 2.3 years duration, so that's quite high by historical standards for us, and that's because we've got a fair amount of bonds in the portfolio. Local nominal bonds at 25%, inflation-linked bonds at 11%. We've got a small allocation to convertible bonds, and then we've got an offshore bond building block as well of about 14%. There are not many government credits in there. It's kind of a basket of various other corporate credits, a diversified basket, which is giving us quite a nice yield, most of which is kind of hedged back into ZAR. So our gross global exposure is 33% here, but our currency exposure is only 27%. What's really nice is the portfolio has a strong yield underpin of just over 8%, despite having a pretty substantial allocation to growth assets. So that's a nice underpin in this kind of environment. The balanced, it's a very similar theme playing through, except as we said earlier, this has less of an asymmetric focus and is focused a little bit more on growth. We therefore have a higher equity exposure. It's just below 60% at the moment. We also have a higher global exposure and a higher FX exposure at 34%. Because of the higher equity exposure, there's slightly less duration in the portfolio. But what's interesting here is I've just split out the duration for you in terms of local duration and offshore duration. And you can see that, although the majority of the duration is still in SA, 1.1 years, there's now a fairly material contribution from offshore duration as well. And that's a fairly recent change. So the underlying yield on this portfolio is 6.6%, also a nice underpin. And that's, again, despite a fairly substantial allocation to risk assets. So I think the last slide is my final summary in recent changes, and then we're going to run out of time. But what's changed is we've been taking profits on risk assets as they've moved higher. So if you looked at the asset allocation, for example, on balanced just over a year ago, we would have been closer to fully invested in equity. We were finding a lot of equity opportunity, particularly overseas at that point. Our SA equity exposure is the lowest it's been in some time because we're finding better options elsewhere. We've got some hedges on our South African equity exposure and more recently on our global equity exposure, which should help a bit to offset a risk-off event. We've been buying inflation-linked bonds more recently, and the portfolios are diversified and they have a quality bias at the moment with an emphasis on strong balance sheets. So we're hoping that the portfolios are robust and they can kind of hang in there in most outcomes. They've got a nice yield underpin, but they still have exposure to some interesting risk assets too.
Thanks very much, Matthew. I know in the interest of time, I think we've just hit to 10 o'clock. I'm sure Matthew's happy to hang around for a couple more minutes to answer questions, but I understand if you do need to sign off and head across. Lisa, maybe if you can just quickly track back to that active asset allocation chart. So I think, again, this chart just shows it's the Abax guys, so over the last 7 odd years and the balance fund, how they shifted the asset allocation as opportunities and more recently as regulation has changed. We know obviously that Matthew has gone through quite a lot of stuff, and if you're not, I guess, as close as we are to them, it could be quite a mouthful. So we will be sending, this has obviously been recorded, so you can watch it again, and we will send the slide pack through so you can go through some of those slides in your own time and sort of really sort of absorb them, because it has been a very insightful session. But yeah, if there's any questions, please pop your hand up or just shout.
Matthew, not so much a question, but rather a comment, just a word of thanks. It was a super insightful presentation of really I think I haven't enjoyed a presentation like that in a long time. You guys are doing some interesting things, and you articulate it really well. So thank you. I enjoyed that.
Yeah.
Thanks very much, everybody. It was nice to catch up.
PJ has a question for us.
Sorry, it was the wrong button. I just wanted to say I also enjoyed it very much. Sorry.
You wanted to do a hand clap and you put your hand up, PJ.
Exactly.
I know you actually George struggle a bit sometimes, PJ. It's okay, man.
Born before computers.
Not joking.
Great. I think, Matthew, I think you obviously answered all the questions. I'm sure if over the next while, as you absorbing the presentation, if questions come to mind, or if you may be too shy to stick your hand up or push the wrong button, or send them through, please just give us a shout, either myself or Adriaan.
Mike, maybe before you conclude the proceedings, I do have a quick question just to take it away from a lot of the investment stuff that you've spoken about, Matthew. Just a quick one on some of the. It's quite interesting to know if your company, or if Abax is doing any initiatives on the South African front, just in terms of impact and social initiatives. Is that something that your business does in terms of like making South Africa a better society? I think it would be interesting to hear if asset managers are contributing on that front.
Yeah, that's something that's been very close to our heart for many, many years. So we have the 3 Abax trusts, which are shareholders in our business. Those trusts basically have been set up by us as shareholders donating our shareholding into those businesses, into those trusts. They are trusts that people in the business are actively involved in. And the 2 largest trusts, the first one, the Development Trust, is mainly involved in early childhood development in SA. So it's about making sure that young people in SA get access to the best education possible, to try and get them started on the right track and hopefully make a contribution later in life. People here are extremely passionate about this cause. That the dividends that it has earned from its shareholding is quite substantial and has been built up over time, and that money has been spent, to try and further that endeavor. The second one is involved with the environment, and there are many environmental issues that we support and get involved with as well. So, we're a business that's, like I told you earlier, we don't have all these sales and marketing people. We're not necessarily looking to try and grow the business. We want to work in a nice environment with nice people and do good work for our clients. We want to be close to our clients, and we want to make a difference in the country that we live in, that has given us all these opportunities. And those are actually our primary objectives. We make a good living here and we like to come to work, and we don't want to do anything to change that. So we would rather keep it like that than get more assets and have to, service the wrong kind of clients, or start changing the culture of our business, which is really, really focused on investments. Of the 25 people that work here, 18 are investment people with over 20 years experience. It gives you a kind of sense of what the business is about. We sit here in the room and we talk about investments all day, and we're all generalists, so we like to look everywhere for anything. We don't want to be boxed into a hole. Anyone can look anywhere for anything. So those 81 bonds, for example, you got to be alive to those opportunities, because those are the kind of things that, if you're alive to, can actually make a difference to the client outcomes over time. So that's how we want to be. That's what we like to be. And we don't want to go out there and compete with everyone else for the next asset or the most airtime on the radio. We just want to sit here and do our thing.
Perfect.
Excellent. Yeah. So if you do have any other questions that crop up over the next whenever, please either give myself or Adriaan or Migs a shout. I guess the beauty about our relationship with you guys and with the asset managers that we do We do have quite close access to them, so if there are questions, you can ask us. If often we'll be able to assist, but if not, we can obviously speak to the manager directly and get you, I guess, feedback from the horse's mouth.
Excellent. Thanks, everyone. Thanks for the support.
Thanks very much, Matthew.